In financial markets, the most dangerous risks aren't the ones that are invisible. They're the ones hiding in plain sight. Publicly announced, fully transparent, yet fundamentally mismeasured by the majority of participants. These are the structural events, the non-discretionary flows that operate like clockwork, indifferent to sentiment or narrative. They represent a force of nature within the market ecosystem, and for those who fail to properly account for their magnitude, the consequences can be severe. We are approaching such an event now. It's not a secret, it's a certainty, published for all to see. The question is, who has done the math correctly? The event is the 2026 rebalance of the Bloomberg Commodity Index, or BCOM. As one of the world's most significant commodity benchmarks, its annual reconstitution dictates the flow of billions of dollars. This year, the index methodology is trimming silver's target weight from 4.49% down to 3.94%. On paper, a reduction of just over half a percentage point seems trivial, a minor adjustment in a vast portfolio. But in the world of institutional asset management, where immense pools of capital are linked to these precise weightings, this small number translates into a very large and very real flow of money. To understand why, we need to talk about drift. Last year's powerful rally in precious metals, particularly silver, caused its actual weight within passive funds to swell. Think of it like a ship taking on extra cargo. As silver's price rose faster than other components, its share of the total portfolio grew, pushing it significantly above its official target. Passive funds, by their very nature, cannot tolerate this deviation. They are now overexposed to silver, not by choice, but as a mathematical consequence of the market's own movement. The rebalance is the moment they are forced to correct this. The scale of this correction is staggering. Billions of dollars in assets under management, tracking an estimated $108.8 billion benchmark to the BCOM, must now realign their holdings. This isn't a discretionary trade. It's not a fund manager making a call on silver's future prospects. It is a mandatory, rules-based execution. The index rulebook is the law, and the rebalance is the enforcement. It is simply math. Here's the precise mechanism. The BCOM's component weights are reset annually based on a 5-year look-back at 2 key factors: production data and trading liquidity. This ensures the index reflects a commodity's real-world economic importance. However, between these annual resets, market prices fluctuate. When a component like silver dramatically outperforms the rest of the index, its portfolio share drifts above its target. To correct this, passive trackers must sell that excess exposure to return to the newly prescribed weight. For silver, the drift is material. Reducing exposure to the new 3.94% target means systematically selling futures contracts to cut the notional value of their holdings. The scale matters because these flows are aggregated across hundreds of products that reference the index. The effect isn't emotional, it's arithmetic applied to enormous balances, implemented on a fixed schedule into whatever liquidity the market offers at that exact time. Inside the major funds and swap desks, this process is already underway. Portfolio managers are modeling the exact gap to target and meticulously planning their execution windows. They aren't debating if they should sell, they are strategizing how to sell with the least market impact. But when everyone is forced to execute the same trade in the same direction over the same short period, impact is unavoidable. The rulebook dictates the action. Personal opinions are irrelevant. In practical terms, the index mechanics will force a wave of selling in silver futures to hit the new target weight. Our estimates point to a required sale of approximately $3.8 billion. In the language of the futures market, that's roughly 13,000 COMEX lots, a figure that represents nearly 9% of the entire market's open interest. To put that in perspective, it's a massive, concentrated position that must be liquidated in a matter of days. Gold faces selling too, on the order of 4.7 billion, but its market is far deeper and can absorb such flows more easily. The execution for this entire operation is slated for January 8th through the 14th, as per the index's published rebalance window. These are price-insensitive flows, designed only to restore weights, not to express a view on market direction. So why do I call this a forced selling event? Because the index is simply resetting to its core methodology, a formula based on production and liquidity inputs. The outperformance of the past year must be sold down, just as underperforming assets must be topped up. This is a structural feature, not a bug. In the sections that follow, I will lay out the mechanics in greater detail, break down the three distinct phases of the rebalance, and explain why price can, and likely will, move the wrong way for a while before it ultimately normalizes. This is the anatomy of a mismeasured risk. The conflict begins here, on the screen and on the floor. Red heat maps signal distress. Silver prices are slipping. This isn't random market noise. It's the predictable, mechanical fallout of a massive, rules-based index rebalance. To navigate what comes next, you don't need a crystal ball, you need a playbook. We'll use a proven three-stage framework to dissect the event, turning a period of forced, non-discretionary selling into a landscape of opportunity. This playbook is built on clear mechanics, tight timing, and a deep understanding of market microstructure. There is no room for hype or guesswork. The three stages are front-running, program execution, and finally, absorption. Each phase has its own distinct signature, its own participants, and its own impact on price and liquidity. Understanding this sequence is the key to anticipating market moves, rather than just reacting to them. Stage 1 is front-running. This is where the smart money acts. Informed participants, aware of the impending sell-off, don't wait for the official rebalance window. They begin to lighten their silver positions beforehand, effectively getting ahead of the tidal wave of institutional selling. This preemptive action lifts volatility and strips the element of surprise from the main event. Estimates point to about $3.8 billion in silver, roughly 13,000 COMEX lots, representing nearly 9% of the total open interest, and about $4.7 billion in gold slated for sale. The official window is January 8th to the 14th, but much of the impact starts days, even a week, beforehand. This isn't illegal insider trading. It's a logical reaction to publicly available index methodology. Orders route to the floor, tickets are stamped, and prints hit the tape. This wave of anticipatory selling means the front-running expands intraday trading ranges and begins to pressure prices well before the index fund's rules even compel them to execute. Context is critical. The gold-silver ratio has been compressing, a long-term signal that silver may be undervalued relative to gold. Yet these powerful near-term flows leave silver acutely vulnerable. For nimble traders, this is a tactical environment. The strategy becomes event-driven. Fade the weak rallies and scalp the manufactured dips. Every move is risk-defined and data-led, not based on long-term fundamentals. Stage 2, program execution. This is the heart of the storm. The index tracking funds, bound by their mandate, begin their price-insensitive selling. Their algorithms are not designed to find the best price. They are designed to execute a specific volume within a specific time frame. This mechanical selling slams into a market where the front runners have already absorbed much of the natural liquidity. The result? The futures term structure kinks sharply toward backwardation. Spot silver begins trading at a significant premium to near-dated futures contracts, recently around 147. That's a clear signal of physical tightness colliding head-on with a flood of paper supply. As the passive sell orders consume all available bids, price levels begin to gap lower, creating a vacuum. These microstructural pressures are amplified by macro frictions. The real-world demand for silver has never been stronger. Port backlogs, customs delays, and the voracious appetite from solar panel lines, EV assembly plants, and AI server farms all scream for more physical metal. The long-term fundamentals say the market is tight. But in this window, the rule set still sells, creating a stark, temporary disconnect between paper price and physical reality. This is the critical point to understand. You cannot reverse a rules-based rebalance mid-flight. It's an automated process that must run its course. You can't reason with it. You can only absorb it. This brings us to stage 3, absorption and repair. Once the programmatic selling exhausts itself, the dynamic shifts. The artificially depressed prices become a magnet for value-driven participants. Commercial hedgers, industrial users, and long-term investors step in to buy. They absorb the excess paper supply and, in many cases, take physical delivery. Liquidity, which had evaporated, begins to normalize as bid-ask spreads tighten and the order book thickens. Prices find a floor and begin to stabilize. To confirm the pressure is off, you monitor the same indicators. Watch the term structure as backwardation eases and the curve flattens. Track micro-positioning data and watch for a recovery in open interest. As these metrics return to normal, the manufactured crisis fades and the market begins its slow repair. This is the fundamental tension, physical metal versus derivative contract flow. It's a temporary, mechanically driven mismatch, but one with very real consequences for those caught on the wrong side. As the forced selling from index rebalancing concludes, the artificial pressure lifts. The paper market, which has been dictating the price, begins to look for its true anchor again, the physical world. While short-term dips are plausible when automated rules sell, they eventually collide with a powerful reality. The structural demand for silver is relentless and growing, from solar panels and electric vehicles to advanced electronics and medical applications. This, combined with persistent supply deficits, builds a formidable price floor beneath the market. Astute physical buyers and investors, recognizing the discount, step in. Watch the gold-to-silver ratio closely. As these cash buyers absorb the excess paper supply, you'll see it begin to compress, signaling silver is regaining its footing. This is where preparation trumps prediction. The goal is to define your entries, your protective stops, and your position size before the opportunity arrives. Seek an asymmetric payoff. Tolerate the residual noise of the market stabilizing, but avoid impulsive reactions. A disciplined approach involves scaling into a position as liquidity returns, and the elevated volatility from the event finally decays. Key indicators signal the pressure is spent. When backwardation in the futures curve eases and open interest begins to rebuild, it shows new capital is entering with confidence. This is the repair phase. By documenting the mechanism and respecting the power of these capital flows, you transform a chaotic event into a structured opportunity. Let probabilities, not noise, guide your decisions. Trade the statistical edge, and above all, stay objective.